Success is supposed to be built on value. You innovate, you sell, you profit, you grow. That's the blueprint of modern business. But at the end of the 20th century, a company appeared that promised something bigger, something revolutionary. A company that claimed you didn't need assets or products or even profit to win. All you needed was belief. This is the anatomy of Enron. Not the scandal, not the headlines. This is about the system, the structure, the lie that looked like success until the moment it didn't. In the 1990s, Enron became a symbol of the future. They didn't call themselves an energy company. They were a platform, a market maker, a vision of capitalism without friction. The idea was simple and seductive. Energy didn't need to be sold like a commodity. It could be traded like money. Electricity, gas, even bandwidth, everything could become a financial product. You didn't need to own it. You only needed to price it. And Enron wanted to be the company that set those prices. To investors, this sounded like a sure thing. A perfect marriage of deregulation and financial engineering. A new kind of business for a new economy. But there was a problem. The future Enron sold was not the future Enron lived. Enron's internal numbers were fragile. Its margins were thin. Its core business of pipelines and energy trading was messy, expensive, and volatile. But the company discovered something far more powerful than profit: expectation. Every time Enron announced a new idea, broadband marketplace, weather derivatives, online energy auctions, its stock soared. Every time analysts heard words like innovation or disruption, they upgraded their forecasts. Enron learned that the appearance of success created more value than success itself. So appearance became the strategy. And that strategy needed a structure. The structure was called Mark II market accounting. In traditional accounting, you record profit when you actually earn it. Enron changed the rule. They recorded profit the moment they signed a long-term contract. It didn't matter if the project made money later. Didn't matter if it failed. It didn't matter if the numbers were just guesses. Enron booked the entire projected profit on day one, even if that projection came from a spreadsheet with no connection to reality. A 20-year contract, profit today. A power plant that wouldn't generate revenue for a decade, profit today. Mark to market didn't create value, it created permission. Permission to turn imagination into revenue. Permission to turn a story into a balance sheet. But the earnings were never enough. Wall Street wanted more growth. So Enron went further. When projects failed, then many did. Enron hid the losses, not by deleting them, but by moving them off the balance sheet and into shell companies, special entities controlled by Enron executives. The losses never appeared in public. The debt never appeared in public. All anyone saw was growth, a rising stock price, a visionary CEO, a company that seemed to defy gravity. Enron wasn't improving its business. It was strengthening its illusion. Every number that mattered became flexible. Every problem became invisible. Enron wasn't being managed. It was being performed. Inside the company, the culture drifted into something dangerous. Employees were ranked every year, and the bottom performers were fired. Success meant survival, and survival meant exaggeration. If you brought good news, you kept your job. If you brought bad news, you lost it. So, bad news disappeared. Projects nobody understood kept expanding. Investments with no path to profit kept receiving funding. Information stopped flowing upward. Executives stopped hearing the truth. Investors stopped asking questions. Enron became a system where the only unacceptable outcome was reality. Meanwhile, Wall Street reinforced the illusion. Banks made money from Enron's stock offerings. Auditors made money from Enron's consulting contracts. Everyone had an incentive to believe the story was real. And belief is one of the strongest forces in finance. The higher the stock climbed, the harder it became to question it. The more spectacular the claims, the more eagerly they were accepted. Enron built a feedback loop. Narrative created valuation. Valuation created credibility, and credibility reinforced the narrative. A loop with no anchor in the physical world. A loop that could only end one way. The first cracks appeared quietly. A failed project overseas. A broadband division with no functioning infrastructure. A trading business stretched thin by speculative bets. But Enron responded the way it always had, not by fixing the cracks, but by covering them. More special entities, more accounting creativity, more debt moved off the books. The company looked healthy, only the math was sick. By 2001, the numbers no longer added up. Debt hidden in shell companies was returning. Executives were jumping ship. The stock price no longer responded to big announcements. Analysts began asking questions Enron couldn't answer. The illusion held as long as the story held, but once the story broke, everything else broke with it. The tipping point came in October. Financial disclosure revealed hundreds of millions in hidden losses, then billions. Then the revelation that one executive-controlled entity had been designed to enrich insiders while defrauding shareholders. Confidence evaporated. The stock fell 50% in a week. Creditors demanded repayment. Company worth $70 billion on paper became worth almost nothing in reality. The collapse wasn't gradual, it was gravitational. When belief disappeared, the valuation followed. In December 2001, Enron filed for bankruptcy. It was the largest corporate collapse in American history at the time. Thousands of employees lost their life savings, invested in a stock their own leadership promoted even as they secretly sold their shares. Pensions vanished, jobs disappeared, billions in shareholder value disintegrated, and the economy learned something uncomfortable. The blueprint for modern business could be abused so aggressively that it looked like success right up until the moment of collapse. After the fall, investigators reviewed the structures Enron had created. None of them were accidents. They were decisions, structured, designed, layered. A system built to extract value without creating it, to manufacture earnings without earning them, to maintain credibility without transparency. Enron didn't fail because it broke the rules. It failed because the rules allowed the illusion to grow. The collapse changed corporate regulation worldwide. It led to the Sarbanes-Oxley Act, reshaped accounting standards, and increased penalties for financial manipulation. But these reforms addressed the symptoms, not the structure. Because the structure that enabled Enron still exists, a market that rewards narrative over fundamentals. Constant pressure for growth and executive incentives tied to short-term stock performance. The tension at the heart of capitalism remains, the expectation of continuous growth versus the reality of limited opportunity. Whenever that gap widens, companies face a choice: admit the slowdown or find a way to disguise it. Enron just pushed that disguise further than anyone else. The lesson of Enron is not just about fraud or a few bad actors. It's about what happens when narrative becomes the product, when companies sell potential instead of performance, vision instead of verification. It's about how quickly success becomes a story and how slowly those stories are questioned when money is being made. Enron didn't collapse because it was extraordinary. It's collapsed because it was ordinary pushed to an extreme. The incentives that built it still exist today in startups, in tech, in finance. The real question isn't how Enron failed. The real question is, how many companies today are built on the same foundations? How many stories will collapse the moment belief disappears? Thanks for watching. If this made you think, consider subscribing for more deep dives.